China's grip on Africa is suddenly weakening. The once sturdy money dragon is running low on fuel. In 2016, Beijing pumped a staggering $28.4 billion into African infrastructure. Today, that sky-high figure has crashed to under $1 billion, barely a trickle.
Could the era of China underwriting big infrastructure projects in Africa be coming to an end? A new report shows Chinese lending to African governments fell sharply in 2020.
For the last 2 decades, China has established itself as Africa's largest bilateral lender, helping bankroll key infrastructure projects on the continent. But a new report by Boston University GDP Center suggests Chinese credit to Africa may be drying up or at least slowing down.
Well, Chinese officials acknowledge that Belt and Road, as they initially imagined it, is just not sustainable. Not only has it left some countries with mountains of debt, but it's also hurt Chinese banks since they're having a hard time getting their money back.
This is the steepest financial retreat in China's modern history of overseas engagement, and nowhere is it more dramatic than in Africa. Between 2018 and 2022, Chinese foreign direct investment FDI into Africa collapsed by 66.7%, plunging from $5.4 billion to just $1.8 billion. Compare that to Latin America, where the drop was a modest 5.7%, or Southeast Asia, which remained relatively stable. Africa has been hit the hardest, and it's not coincidental, it's structural. According to the Institute for Security and Development Policy, the scale back is rooted in China's internal economic crisis, real estate implosions, soaring youth unemployment, and a retreat from risky overseas debt exposure. The Belt and Road Initiative, once Beijing's crown jewel, is buckling. In Kenya, the $4.7 billion Mombasa-Nairobi standard gauge railway is bleeding losses. In Ethiopia, the Addis Ababa-Djibouti rail line intended to leapfrog colonial infrastructure has failed to turn a profit. The old colonial railway? It's back in service. The optics are shifting too. In August 2023, a Western-backed consortium secured the 1,700-kilometer Angolan-Lobito Corridor project, transporting Congolese minerals to the Atlantic, shutting China out of a strategically vital region. This deal was brokered by the U.S., EU, and private stakeholders, not Beijing. Projects that were once Chinese monopolies, like Zambia's 5,000 kilometers of road infrastructure, have now been awarded to European engineering firms. Cameroon's signature Yaoundé-N'Tsamalan motorway? No Chinese involvement. These aren't isolated incidents, they represent a structural decoupling. The Africa report details the trend here. And here's the most damning metric of all. In 2022, only 1.1% of China's total outward investment landed in Africa. Despite Beijing's self-promotion as the champion of the global south, the continent remains a side note in actual fiscal terms. The IMF and Le Monde both confirm the same Chinese rhetoric may stay loud, but the money has gone silent. The myth of an indomitable Chin-Africa has shattered. The data has spoken, and the vacuum is growing. This isn't just a geopolitical reshuffle, it's a seismic redefinition of Africa's development model, and it comes with massive global consequences. For 2 decades, China filled a vacuum left by cautious Western lenders, offering $170 billion in loans to African nations between 2000 and 2020. The infrastructure boom was explosive. 6,000 kilometers of railway, 20 ports, 80 power plants, and even the African Union HQ in Addis Ababa were built with Chinese backing. But now that tap is dry, and with it, Beijing's leverage. According to Le Monde, China's aid and FDI are no longer seen as infinite or inevitable. African nations, once content to trade sovereignty for steel, are rethinking the cost of dependency. And here's where it gets real. China's retreat isn't just economic, it's reputational. Beijing built more than roads. It built influence. Its diplomats outflanked the West at the UN, secured near-unanimous African support for Taiwan isolation, and helped elect Chinese officials to lead global bodies like the FAO. But without the billions to back those bonds, the political glue is starting to peel. And in a continent where public approval matters more than ever, China's image is taking hits. A 2023 survey by the Africa Report revealed African approval of China fell below 50% in several key economies, including Nigeria and Kenya. This moment matters because it rewrites the power map. The EU's Global Gateway Initiative and the US's Prosper Africa campaign were once seen as hollow counteroffers. Not anymore. Now, African capitals from Lusaka to Accra are inviting Western tech and clean energy players into conversations once dominated by Beijing. And with China's domestic crisis showing no signs of recovery, these new alliances may not just be alternatives, they could become the default. The end of China's dominance doesn't leave Africa empty-handed. It gives it leverage. To understand why China is losing control of Africa, you need to understand how it won it in the first place. It began in 2000, with the launch of the Forum on China-Africa Cooperation, FOCAC, a diplomatic juggernaut designed to outmaneuver the West. At the time, much of Africa was still reeling from IMF-imposed austerity and the collapse of Cold War-era patronage systems. Into that void stepped Beijing, flush with surplus capital, labor, and steel. Unlike the conditional loans of Western institutions, China promised no strings-attached finance. The deal was simple: resources for infrastructure, and it was executed with breathtaking speed. By 2020, China had completed more than 1 in 3 major infrastructure projects across the continent, from power grids in Ghana to rail networks in Kenya to digital surveillance systems in Zimbabwe. What looked like a benevolent partnership was in fact a geostrategic operation. China used concessional loans to open markets for its construction giants, offload industrial overcapacity, and lock in commodity supply chains. By 2009, it became Africa's largest trade partner, overtaking the U.S. Today, it remains Africa's top bilateral creditor. According to the China-Africa Research Initiative, Chinese firms have built more than 45 stadiums, 130 hospitals, and 20 ports, most with state-backed loans repayable in hard currency or resource guarantees. But that success came at a cost. By 2016, many of these mega projects had begun to reveal their weaknesses: cost overruns, poor maintenance, and ballooning sovereign debt. Zambia, for example, borrowed $6.6 billion from China over 15 years. When commodity prices crashed and repayment deadlines loomed, the dream of Chinese-backed growth turned into a fiscal noose. Zambia's 2020 default was a turning point not just financially, but symbolically. It shattered the illusion that Chinese lending was risk-free. And now China's once-vaunted South-South partnership model is under siege, collapsing not from Western pressure, but from within. If you find this analysis valuable, subscribe and share, because geopolitical shifts don't happen in slow motion, and neither should your understanding of them. So Africa now stands at a strategic crossroads, and the stakes couldn't be higher. As China pulls back, it leaves behind a network of half-finished projects, mounting debt, and diplomatic uncertainty. According to the IMF, Chinese slowdown is projected to shave entire percentage points off African GDP in the near term, especially in nations deeply tethered to Chinese capital flows. In Zambia, Ghana, and Ethiopia, countries that collectively hold over $40 billion in Chinese debt, that fiscal pressure is already triggering spending freezes and emergency restructuring deals. Meanwhile, critical projects like Kenya's Naivasha-Kisumu Railway and Cameroon's port upgrades have stalled indefinitely due to lack of follow-on funding. But this isn't just an infrastructure crisis, it's a geopolitical one. China's withdrawal has opened up a vacuum of influence at a time when global powers are jostling for strategic footholds across Africa. The U.S., for instance, has fast-tracked new diplomatic engagements under Prosper Africa, while the EU is offering global gateway financing to lure countries away from Chinese dependence. Even middle powers like India, Turkey, and the UAE are launching competitive infrastructure initiatives in countries where China once dominated. In the words of a 2024 semaphore analysis, China's elevated game is no longer the only one in town. And while China still clings to influence through commodity trade and soft power platforms like Confucius Institutes, its economic decline has fractured the core pillar of its Africa strategy: credible scale. Beijing can no longer outspend rivals. In fact, at the 2023 China-Africa Economic and Trade Expo, Beijing pledged just $10 billion in new investment, 50%, lower than 2019, and barely a tenth of what the continent needs annually for basic infrastructure renewal. The risk? A fractured development pipeline, rising anti-Chinese sentiment, and growing vulnerability to debt contagion across the global south. The illusion of unlimited Chinese capital has collapsed, and now Africa must decide what fills the void. What comes next won't be a clean break. It will be a fragmentation and a contest for who controls the pieces. First, expect more African governments to renegotiate or default on Chinese loans. Zambia led the way with its 2020 default, but others like Ghana, Angola, and Ethiopia are close behind. The G20's common framework, designed to include China in multilateral debt relief, has moved at a glacial pace. ISDP analysis notes that by 2023, dozens of Chinese-funded projects were stalled while repayment terms sat in limbo. The result? Either restructuring or abandonment, and either option reduces Beijing's grip on policy leverage. Next, a wave of strategic realignment. Countries burned by debt traps are turning toward alternative financing. The EU's €300 billion global gateway and the US's $600 billion Build Back Better world, B3 initiative, are quietly moving in. In Angola, Cameroon, and the DRC, Western and Indian-backed infrastructure deals are replacing what were once Chinese monopolies. Even the Africa report frames this as a new power dynamic, where China keeps a discrete presence by necessity, not strategy. Then expect a recalibrated China to shift from megaprojects to microcontrol. Instead of bridges and ports, Beijing will focus on strategic digital infrastructure, logistics, and resource extraction deals that offer faster ROI. Analysts like Thierry Vercoulon call this the retreat to the profitable core. Beijing may no longer dominate African railways, but it will compete fiercely for rare earths, lithium, and cobalt in countries like the DRC and Zimbabwe. According to Le Monde, China is already restructuring its Belt and Road blueprint to prioritize targeted investments with geopolitical yield over flashy construction. The final scenario, a fractured map of influence, China entrenched in mineral corridors, the West embedded in health and tech sectors, and a host of regional players maneuvering in the gaps. This isn't Cold War 2.0, it's a geopolitical marketplace. And Africa? It no longer just receives offers, it evaluates them. Africa's so-called dependency on China is cracking, and some of the continent's boldest economies are flipping the script. Take Kenya. Once hailed as the poster child for Chinese-funded infrastructure, it's now spearheading a strategic diversification campaign. President William Ruto, elected in 2022, openly criticized his predecessor's ballooning Chinese debts and followed through. By October 2023, he'd flown to Beijing, not to plead for new megaprojects, but to negotiate a final $1 billion loan to finish only the most viable infrastructure still under construction. Then, no more blank checks. Le Monde confirms it here. Meanwhile, Zambia, having defaulted in 2020, has leveraged its crisis into bargaining power. In 2023, it secured multilateral restructuring deals via the Common Framework, with China grudgingly at the table. Now, Lusaka is channeling new investment through public-private partnerships and is prioritizing domestic resource mobilization over foreign debt. ISDP data notes that both Zambia and Rwanda are increasingly tapping local bond markets, a sign that fiscal sovereignty is becoming part of the national identity. The pivot is also tactical. In Ghana, stalled Chinese-backed energy projects have been replaced by US-funded renewables and German-financed health tech, giving Accra diversified leverage. Nigeria is fast-tracking trade routes with Indian and UAE investors. Angola, it just handed 1,700 kilometers of railway infrastructure to a Western-led consortium, shutting Beijing out of a region it once dominated. The Africa report frames these moves as the start of a new economic logic one, where African governments shop for deals instead of surrendering to monopolies. And make no mistake, this isn't just about money. It's about data, energy, logistics, and narrative control. In 2024, the African Union announced a plan to audit all foreign infrastructure contracts signed since 2000, a direct response to the opacity of China's loan terms. The symbolism is loud. Africa is now the regulator, not the regulated. This is what a counter-strategy looks like. Imperfect, improvised, but increasingly effective. China's grip on Africa didn't just weaken from within, it was pried open by a rising chorus of rivals, allies, and former bystanders now turned strategic competitors. Leading the countercharge is the European Union, which launched its €300 billion global gateway program in late 2021 as a direct response to Beijing's Belt and Road initiative. By 2023, the EU had already committed over €6 billion to projects across Angola, Senegal, Kenya, and Mozambique in health systems, green energy, and digital infrastructure. In Angola specifically, EU-backed firms seized the Lobito corridor from Chinese operators, a rail artery crucial for mineral exports from the DRC. This isn't symbolic, it's structural. Read it here via the Africa report. Then there's the United States, which under both the Trump and Biden administrations re-engaged Africa with surprising consistency. Trump's Prosper Africa program and Biden's Build Back Better world, B3, have both matured into financing platforms for clean energy, fintech, and digital infrastructure. In 2023, the U.S. signed a $504 million compact with Benin and Niger for corridor upgrades areas once firmly under Chinese influence. And a 2025 semaphore piece warns that while China may still be Africa's top bilateral creditor, its transactional diplomacy can't compete with the legacy-building soft power of Western aid systems like USAID, which fund hospitals, vaccines, and education. Other players are entering too. India, through the India-Africa Forum Summit, has increased its annual grants and capacity-building programs, offering technical training and digital startups instead of hard infrastructure. Turkey is building logistics hubs in Djibouti and Somalia, while the UAE is underwriting free trade corridors in West Africa. Even Japan, via the Tokyo International Conference on African Development, TICAD, has reactivated its role with a $30 billion development pledge focused on quality growth, a direct dig at China's debt-laden legacy. The upshot? The field is no longer tilted toward one power. China's dominance depended on being the only game in town. Now, it's just one of many. And in a buyer's market, the seller with the most flexible terms, not the deepest pockets, wins. If China's retreat from Africa was a war game, the outcome maps are already being drawn and they aren't pretty for Beijing. Simulations run by global think tanks like the Center for Strategic and International Studies, CSIS, and the Institute for Security and Development Policy, ISDP, paint a stark picture. In multiple forecasting models published in 2023, a continued decline in Chinese FDI projected to fall another 40%. By 2027 would reduce China's share of African infrastructure investment from 36% in 2018 to under 15% within 5 years. That's not a dent. That's a collapse. ISD's full projection is available here. In scenario-based models comparing development outcomes, countries like Ethiopia, Kenya, and Nigeria show stark divergences depending on financing partner. When funded by diversified pools, EU, US, India GDP per capita growth is estimated to rise by 0.8% annually over a 10-year window. Under continued reliance on China, however, debt-to-GDP ratios spike, with infrastructure projects either incomplete or too costly to maintain. The Addis-Djibouti Railway, once forecast to generate $500 million in trade annually, now struggles to recoup even 20% of its operational costs, according to Le Monde. Meanwhile, Boston University's Global China Initiative confirms a sharp pivot in Chinese economic behavior. Loans to Africa have dropped below $1 billion annually, the lowest in nearly 2 decades. And the Chinese presence in multilateral initiatives like the G20's Common Framework has revealed strategic vulnerability. Beijing is slow to restructure debt and reluctant to engage with transparency norms, often clashing with Paris Club nations. These delays have pushed African states to rethink dependency, the real war game scenario. In a multipolar investment future where China, the US, EU, India, and the UAE are all players, the entity with the fastest, cleanest financing terms wins. China's previous advantage was speed and volume, but now, cost, reputation, and delivery timelines dominate the calculus. The battlefield isn't ports and pipelines, it's spreadsheets, courtrooms, and contract clauses. China's Great Africa experiment is teetering, and the question now isn't whether it's ending, but how violently it will unravel. The numbers don't lie. From a high of $28.4 billion in loans in 2016 to less than $1 billion in 2022, China's capital outflow to Africa has imploded. Debt renegotiations are piling up, defaulted projects are haunting budgets, and Beijing's vaunted Belt and Road strategy is no longer an unstoppable current, it's a leaking pipeline. Even Chinese scholars are calling for a pause and pivot on African strategy, fearing the blowback of overreach and the growing specter of reputational collapse. Read the full breakdown from ISD, but here's what we don't know. Will China double down on core mineral corridors DRC, Zimbabwe, Angola, or cut losses and pull out altogether? Will African governments lock in new partnerships with the West and India, or keep Beijing on the back burner for leverage? The African Union's plan to audit every Chinese deal signed since 2000 could trigger a diplomatic detonation if it exposes widespread abuse or corruption. And if more countries follow Zambia's path into default, Beijing may be forced to bail out not just allies but its own credibility. More ominously, China's shrinking wallet collides with a broader crisis: an aging population, an imploding property market, and fractured trade with the US. What happens when the world's second-largest economy can no longer bankroll its global ambitions? Africa, once the stage for China's rise, may now become the proving ground for its limits. The next debt crisis won't be about repayment. It'll be about reputation, retreat, and revenge, and it's already on the move.